Let me ask you something strange. What if the single most powerful financial move you could ever make was the one you never told anyone about? Not because it's illegal, not because it's complicated, but because the moment you open your mouth and share it, it stops working. Sounds almost paranoid, right? Like something out of a spy thriller, not a personal finance video. But here's the thing. Warren Buffett, the man who turned $100 into over $100 billion, has lived by this idea for over 6 decades. And when you understand why he operates this way, you'll start to see money, decisions, and human psychology in a completely different light. So stay with me here, because by the end of this video, you're going to realize that your biggest financial enemy might not be inflation, bad investments, or even your spending habits. It might be your own mouth.
Picture this. It's a Friday evening, and you're sitting with your friends at dinner. Conversation is flowing, food's good, and then someone asks, "So what are you up to these days? Anything exciting?" And you feel it, that little rush, that tiny surge of pride bubbling up. You've been quietly researching a stock for 3 weeks. You found a small company that nobody's talking about yet. The numbers look solid, the product is undervalued, you're genuinely excited, and now someone's asking. So you tell them, you explain the whole thing, the company, the opportunity, why you think it's going to go up. Everyone listens. Someone says, "That sounds interesting." Another person says they might look into it. You feel great, validated, smart, and then you never actually buy the stock. Sound familiar? Or maybe a different version of the same story. You tell your family you're going to start a side business. You tell your coworker you're cutting your spending and aggressively saving this year. You post on social media about your new financial goals. And then, somehow, the momentum just dies. Most people chalk this up to laziness or a lack of discipline, but what's actually happening goes much deeper than that. It's rooted in how the human brain is wired. And once you understand it, you'll never look at financial decision-making the same way again.
Let's start with a simple but powerful idea from psychology. In the 1920s, a Russian psychologist named Bluma Zygarnik noticed something interesting while sitting in a cafe. She observed that waiters could remember long, complicated orders with perfect accuracy, but only until the bill was paid. The moment the transaction was complete, they forgot almost everything. What she discovered is now called the Zygarnik effect. The human brain naturally stays focused on unfinished things. Incomplete tasks create a kind of mental tension, an open loop that keeps your mind engaged and motivated. But here's the flip side, and this is where money psychology gets really interesting. When you talk about a goal, when you announce it, declare it, share it, your brain does something sneaky. It starts to treat the announcement itself as a form of completion. Psychologists call this social reality. Your identity has now publicly shifted. You've told people you're an investor, you're a saver, you're a goal setter. And your brain, which constantly seeks consistency with your self-image, starts to relax. The loop feels closed, even though you haven't done anything yet. A study by NYU psychologist Peter Gollwitzer found exactly this. When people shared their intentions with others and received acknowledgement, they were less likely to follow through. Not more, less. The applause came too early, and the brain moved on. Now take this principle and apply it to money, to investing, to wealth building. Every time you announce your financial moves before you make them, you are psychologically rewarding yourself for doing nothing. You get the dopamine hit, the validation, the excitement, the feeling of being someone who has a plan without putting any actual skin in the game. It feels like progress, but it's actually a trap.
And now, enter Warren Buffett. Buffett has given thousands of interviews over his lifetime. He's written annual letters to shareholders for decades. He is, in many ways, one of the most transparent investors in history. But there is one thing he almost never does. He doesn't telegraph his next move. When Berkshire Hathaway, Buffett's company, is quietly accumulating a position in a stock, the public doesn't know. The media doesn't know.
Sometimes even his own team doesn't know the full picture until it's done. And this isn't accidental, it's a deliberate, calculated strategy. There's a concept in military strategy, famously used by Sun Tzu, that says, "Move like lightning when it's time to act, and be as silent as the sky before a storm when it's time to prepare." Buffett applies this to finance with surgical precision. Here's what actually happens in the market when a well-known investor reveals their plans early. Let's say Buffett publicly announces, "We're considering buying shares in Company X." What do you think happens next? Instantly, millions of retail investors pile in. The price shoots up. What was an undervalued opportunity becomes an overpriced one, almost overnight. The very act of announcing the move destroys the advantage that made the move worth making. This is called the announcement effect, and it's not just a problem for billionaires. It affects you too, just on a different scale.
Let me give you a very simple, everyday version of this. Imagine you've been eyeing a specific stock. Let's call it Company A, trading at $20 per share. You've done your homework. You think it's worth $40. You're ready to buy. But first, you post about it in your investment group chat, or you mention it to a friend who's also into stocks. Now your friend buys it. Then their friend buys it. Maybe someone shares it in another group. The price ticks up to 23, then 25. By the time you actually go to place your order, the easy money is already gone. The gap between price and value, which was your opportunity, has started to close. You talked your own profit away. And here's the cruel irony. You didn't even realize it. Now, multiply this across every financial decision you've ever shared too early. The savings plan you told people about but never started. The investment you researched but talked yourself out of by getting too many opinions. The business idea you pitched to friends who poked holes in it before you'd even tried. Silence, it turns out, is one of the most underrated financial tools on the planet.
But let's go deeper, because this isn't just about keeping secrets to get better stock prices. There's a more profound psychological layer here that touches on how wealth is actually built and why most people never build any. There's a concept called identity diffusion. When you share a big financial goal widely, especially before you've taken action, you invite other people's beliefs, doubts, and frameworks into your thinking. Your uncle who thinks the stock market is just gambling, your friend who tried to start a business and failed, your coworker who thinks a safe salary is the only real security. They don't mean any harm, but their skepticism, their risk aversion, their own unexamined fears, they all start mixing into your internal conversation. What began as a clear, confident decision becomes clouded. You second guess, you delay, you modify your plan so much to satisfy other people's comfort levels that it no longer resembles the original idea. You didn't lose your opportunity because of the market, you lost it because you outsourced your conviction. This is something the ultra-wealthy understand deeply, not because they're arrogant or secretive by nature, but because they've learned, often through painful experience, that the quality of your decisions degrades in direct proportion to the number of unqualified opinions you allow into your process. Think about it like a recipe. If you're baking something you've never baked before and you ask 10 different people for advice at the same time, one says more sugar, one says less flour, one says use a different oven temperature, you'll end up with something that satisfies nobody and is edible to no one. Wealth building works the same way. Your financial strategy needs to be developed in protected silence, refined slowly, tested carefully, and only shared selectively with people who have relevant knowledge or a genuine stake in your success. There's also something powerful at work here called strategic optionality. When you haven't announced your move, you remain free. Free to change direction, free to upgrade your thinking, free to walk away from something that no longer makes sense without the embarrassment of having to explain yourself publicly. Buffett has done this more than once. He's changed positions on companies he once loved. He's admitted mistakes, but always after the fact, and always in his own time. on his own terms. When you keep your moves private, you give yourself room to be wrong without the social cost of being wrong loudly. And in investing, in wealth building, being able to change your mind quickly and cleanly is one of the most valuable things you can possess. Ego is expensive. Public declarations of strategy make it harder to course correct because now your identity is tied to the plan. Changing the plan feels like losing face. Buffett has one of the largest egos in finance when it comes to long-term conviction, but it's a private ego. He doesn't make his moves hostage to public opinion. Now here's something that ties all of this together in a surprising way. There's a phenomenon studied in behavioral economics called social proof. It's the reason people follow trends, buy what their friends buy, and invest in whatever's getting news coverage. When something is widely talked about, when it's visible, people assume it must be a good idea. The loudness becomes the signal. But the most reliable wealth-building opportunities are almost never loud. They're quiet. They're in the places people haven't looked yet. They exist in the gap between what something is actually worth and what people currently think it's worth. And that gap closes the moment people start talking about it. Buffett famously said he feels comfortable when everyone else is uncomfortable, and cautious when everyone else is celebrating. That's not just a clever quote about market cycles. It's a statement about information asymmetry, about the advantage that comes from knowing something before the crowd does, and more importantly, acting on it before the crowd does. You can't be ahead of the crowd if you're busy telling the crowd where you're going.
So what does all of this mean for you, practically, on a real-world level? Here's how you can start applying the Thunderbolt principle to your own financial life. First, make the decision, then share, if at all. There's a powerful inversion that wealthy thinkers use. Instead of sharing a plan and then doing it, they do it first and share the result later, or sometimes never. Open the investment account, make the first contribution, start the business registration, sign up for the course. Then, if you want to, tell someone. But by then, your brain already has proof of your own action. You're not seeking validation, you're reporting a fact. Second, be selective about your financial counsel. You don't need to be secretive with everyone. What you need to do is be intentional about who you talk to. Seek out people who have the outcome you're working toward, not people who simply care about you but have no experience with the thing you're trying to do. Wanting emotional support and wanting strategic advice are two different needs. Know which one you're looking for and go to the right person for each. Third, protect your conviction window. In the early stages of any financial decision, the first few days or weeks after you've made up your mind, your thinking is the most fragile. You're excited, but also vulnerable to counterarguments that sound reasonable but are actually just noise. In this phase, be deliberate about silence. Don't post, don't pitch, don't poll. Sit with your thinking, research deeply, then act. Fourth, let results speak instead. There's something deeply satisfying and strategically powerful about quietly building wealth and only revealing it through outcomes. Not to be smug about it, but because it removes the social performance aspect from your financial life entirely. Money stops being something you talk about and becomes something you do. The people who are genuinely building wealth are usually not the ones loudly narrating every financial move in real time. They're the ones you only understand in hindsight, when you look back and realize they've been quietly building something significant all along. Fifth, and this is perhaps the most important, understand the difference between talking about wealth and building wealth. These two activities feel similar, but they live in opposite directions. Talking about wealth is social, it's performative, it gives you community and validation and a sense of momentum. It feels like progress. Building wealth is private, it's slow, it's boring for long stretches. It looks like nothing is happening until suddenly something significant has happened, and then it compounds, quietly, relentlessly, without needing an audience.
Most people spend so much energy on the first activity that they never generate real momentum on the second.
Let's bring this all the way back to where we started. Warren Buffett didn't build one of the greatest wealth creation stories in human history by being flashy, loud, or first to share his strategy. He built it by thinking deeply, acting decisively, and moving like a thunderbolt, sudden, powerful, invisible only after the impact. There's a line often attributed to him that captures this perfectly. "I don't look to jump over 7-foot bars. I look around for 1-foot bars I can step over." And here's what's profound about that. You can only find the 1-foot bars if you're actually looking, quietly, carefully, without the noise of other people's expectations clouding your vision. The financial world is loud. Social media is loud. Financial news is loud. Everyone is sharing their moves, their portfolios, their predictions, their losses and gains in real time. And in all that noise, the person who sits quietly, who thinks, who researches, who acts without announcement, has a structural advantage that no amount of stock tips or trending content can replicate. Because they're the only one who isn't performing. They're the only one who's actually playing the game. So here's the thought I want to leave you with. What is the one financial move you've been thinking about? The one that feels right? The one you've researched? The one you keep coming back to that you haven't made yet because some part of you is still waiting to tell someone about it first? What you just did it. Not for the likes, not for the validation, not for the dinner table story, but quietly, deliberately, like a thunderbolt nobody saw coming. Because the most powerful financial move you'll ever make might be the one nobody knows about until it's already done.